Silver traded above $80 per troy ounce this weekend. Central banks from 11 jurisdictions convened for what several wire services described as an unscheduled coordination call. The timing is notable. These calls typically occur during scheduled Basel Committee meetings or International Monetary Fund gatherings, not on weekend evenings between Christmas and New Year. The juxtaposition of a precious metal trading at a 14-year nominal high and simultaneous central bank communication outside normal protocols raises questions about what conditions might prompt both developments simultaneously. The circumstances bear examining against a specific historical period. Between August 1979 and January 1980, silver rose from roughly $9 to over $48 per troy ounce. Gold moved from $287 to $850 in the same window. The Federal Reserve's policy rate stood at 10.94% in August 1979. By December, it had been raised to 13.82%. Real rates, measured against the Consumer Price Index, remained negative throughout this period despite nominal tightening. The yield on 10-year Treasury securities was 9.44% in August and climbed to 10.8% by year-end. Yet inflation was running between 11% and 13% annualized. This meant holders of government debt were experiencing guaranteed purchasing power loss. Under these conditions, institutional capital began rotating toward tangible assets. The Hunt brothers' accumulation of physical silver contracts is well documented, but broader demand came from pension funds, insurance companies, and foreign central banks seeking alternatives to dollar-denominated instruments. The Federal Reserve, under Paul Volcker, eventually raised the federal funds rate to 20% by June 1981. Silver peaked in January 1980 and subsequently declined as real rates turned decisively positive. The comparison is not about market manipulation or individual actors. It concerns the structural relationship between real interest rates, inflation expectations, and the behavior of capital-seeking preservation rather than return. In 1979, monetary policy was tightening in nominal terms, but loosening in real terms. The system was experiencing simultaneous currency depreciation and rising borrowing costs, a combination that historically destabilizes confidence in fiat currency stability. Precious metals functioned as a release valve for that instability. Central banks at that time had limited coordination mechanisms compared to today. The Plaza Accord would not occur until 1985. The Basel Committee existed, but had narrow focus. When silver spiked in 1980, there was no immediate multilateral response beyond domestic margin requirement changes and eventual interest rate policy that took months to transmit. Today's environment shares certain characteristics, but operates within different structural constraints. Silver's move to 80 occurs after a prolonged period where real rates were deeply negative from 2020 through mid-2023, then turned modestly positive as inflation declined and central banks held policy rates elevated. The Federal Reserve's current policy rate stands at 4.33% as of December 2025. Core personal consumption expenditures inflation is reported at 2.8% annualized. The emergency weekend coordination call represents a pattern that emerged during previous periods of system stress. In September 2008, central banks conducted multiple weekend calls as interbank lending markets froze. In March 2020, similar communications occurred as dollar funding markets experienced acute stress despite abundant nominal liquidity. These calls typically address coordination of liquidity provision, currency swap line activation, or messaging alignment to prevent competitive devaluation or conflicting signals. The fact that such communication occurs during a precious metals rally, rather than during an obvious credit event or payment system disruption, suggests concerns about market functioning or confidence dynamics that are not yet visible in conventional stress indicators. The silver market itself has specific characteristics worth noting. Annual mine production approximates 800 million troy ounces globally. Industrial demand, primarily from solar panel manufacturing and electronics, consumes roughly 60% of supply. Investment demand from coins, bars, and ETFs accounts for approximately 25%. The remaining portion goes to jewelry and silverware. When investment demand surges, it directly competes with industrial users for a relatively inelastic supply. Mine production cannot rapidly increase because silver is primarily extracted as a byproduct of copper, lead, and zinc mining. This supply inelasticity means price moves can be disproportionate to demand changes. In 1979 and 1980, investment demand overwhelmed industrial demand as inflation expectations became unanchored. Silver's price movement exceeded gold, in percentage terms because of this supply constraint combined with smaller market size. Current silver demand data shows exchange-traded fund holdings increased by approximately 112 million ounces since January 2024. This represents roughly 14% of annual mine production moving into investment vehicles. Jewelry demand in India, historically the largest consumer market, declined by 8% year over year through November 2025, indicating price sensitivity among traditional buyers. Industrial demand from solar panel manufacturing increased by 9% year over year. Yet this growth occurred alongside price increases from $67 per ounce in January 2024 to current levels. Industrial users typically resist buying at elevated prices unless they expect sustained availability constraints. The combination of rising investment demand, declining discretionary consumption, and continued industrial buying, despite high prices, suggests different buyer groups are operating under different assumptions about future availability or currency stability. Gold's behavior provides additional context. Gold traded at $2,143 per troy ounce as of Friday's close. This represents a 31% increase from January 2024 levels. The gold to silver ratio currently stands at approximately 34.1, meaning 34 ounces of silver equal 1 ounce of gold in price terms. Historically, this ratio has fluctuated between 40.1 and 80.1 over the past 40 years. The current ratio is near the low end of that range, suggesting silver has appreciated faster than gold on a percentage basis. During the 1979-1980 period, the ratio briefly reached 17.1 at silver's peak, indicating even more extreme relative movement. However, comparing ratios across different monetary regimes has limited analytical value. What matters more is the directionality. When silver outperforms gold, it typically signals either industrial demand expectations or speculative momentum, or both. Given current industrial demand growth rates, the magnitude of silver's move suggests factors beyond industrial fundamentals are influencing price. Central bank gold purchases provide another data point. Official sector purchases reached 912 metric tons through the first 3 quarters of 2025, according to World Gold Council data. This pace exceeds the 10-year average by approximately 42%. Central banks accumulating gold during a period when real rates are modestly positive deviates from historical patterns, where such buying typically intensifies when real rates are negative. The behavior implies concerns beyond immediate yield optimization. Possible explanations include diversification away from concentrated reserve holdings, preparation for alternative settlement systems, or anticipation of future monetary instability. None of these explanations can be confirmed through public statements, which remain focused on routine portfolio management language. The European Central Bank's balance sheet composition has shifted measurably over the past 18 months. Holdings of government securities decreased by 7%, while gold reserves remained constant in tonnage, but increased in reported value due to price appreciation. The Bank of Japan maintained zero interest rate policy until March 2024, then initiated modest tightening. Japanese government bond yields remain below 1% on 10-year maturities, despite inflation running above 2% for the first time in decades. This produces deeply negative real rates in Japan, even as other major economies show positive real rates. The divergence in real rate environments across major currency zones creates arbitrage opportunities and capital flow pressures that did not exist to the same degree in 1979, when most developed economies faced similar inflation dynamics simultaneously. The question of why precious metals are behaving as if real rates are deeply negative when measured. Real rates show modest positive territory has several possible explanations, none of which can be confirmed definitively. First, reported inflation metrics may not capture the full scope of price changes affecting certain economic actors. If corporations or institutional investors face input cost inflation higher than consumer price indices reflect, their perception of real rates would differ from official statistics. Second, forward-looking inflation expectations may exceed current realized inflation. Precious metals often trade on expectations rather than current conditions. If market participants anticipate inflation reaccelerating due to fiscal dynamics, energy prices, or monetary policy constraints, current real rates become less relevant than expected future rates. Third, confidence in currency stability may be deteriorating independently of measurable economic variables. This type of shift is difficult to quantify, but can manifest in asset price movements before appearing in conventional indicators. The emergency coordination call could address several potential concerns. If precious metals markets are experiencing settlement issues or liquidity constraints, central banks might coordinate to ensure bullion banks have adequate funding. During the March 2020 stress, gold markets experienced basis blowouts between futures and physical that required intervention. If currency volatility is increasing beyond what exchange rate movements show, coordinating communication could prevent destabilizing speculation. Alternatively, the call might concern alignment on inflation communication or monetary policy trajectories to avoid markets pricing in conflicting paths. Without access to the discussion, any explanation remains speculative. The fiscal dimension provides additional complexity. U.S. federal debt reached $36 trillion as of December 2025. Interest expense on this debt is running at approximately $1.2 trillion annually, representing roughly 4.3% of GDP and 17% of federal revenues. This debt service ratio approaches levels last seen in the early 1990s, but that period followed the Volcker disinflation and occurred during declining interest rate environments. Current debt service is rising in an environment where rates remain elevated and structural deficits continue. The combination constrains monetary policy options. If inflation requires further tightening, debt service costs increase. If recession risks require easing, inflation expectations may become unanchored. This policy constraint did not exist in 1980 because debt to GDP was 40% compared to today as 123%. The difference matters for precious metals because it affects the credibility of inflation-fighting commitments. In 1980, the Federal Reserve could raise rates to 20% because debt levels were manageable, and political will existed to accept recession as the cost of restoring price stability. Today's debt burden makes such extreme tightening mechanically difficult without triggering sovereign debt concerns. If market participants perceive this constraint, they may doubt central banks' ability to maintain restrictive policy long enough to durably lower inflation. This perception gap could explain why precious metals trade as if real rates are negative even when calculations show positive territory. The market may be discounting official rates based on sustainability concerns. China's role in precious metals markets has evolved substantially since 1980. Chinese gold demand reached 1,032 metric tons in 2024, representing approximately 30% of global demand. Silver demand from Chinese industrial users, particularly solar panel manufacturers, accounts for roughly 25% of global industrial consumption. The Shanghai Gold Exchange operates as a major price discovery mechanism alongside London and New York markets. Chinese monetary authorities have increased gold reserves by approximately 200 metric tons since early 2023, according to official reports. Though actual accumulation may differ from reported figures, the integration of Chinese demand into global precious metals markets creates different dynamics than existed in 1980, when China's economy was substantially smaller and less integrated into global commodity flows. The solar panel industry's silver intensity provides specific structural demand that did not exist historically. Each gigawatt of solar panel production capacity requires approximately 1 million troy ounces of silver for photovoltaic cell manufacturing. Global solar installations are projected to reach 600 gigawatts annually by 2026, implying 600 million ounces of silver demand from this single application. This represents 75% of current annual mine production dedicated to one industrial use. If solar build-out accelerates due to energy security concerns or climate policy, industrial demand could structurally tighten supply regardless of investment demand. This creates a fundamental support level for silver prices that did not exist in previous decades. The derivatives markets in precious metals have also evolved considerably. Silver futures open interest on COMEX currently stands at approximately 134,000 contracts, representing 670 million troy ounces of notional exposure. This exceeds annual mine production. The concentration of short positions among a small number of commercial banks creates potential for short covering if prices rise rapidly. During the 1980 silver spike, futures markets were smaller and position limits were different. The current market structure means price movements can become self-reinforcing if leverage positions are forced to cover. Whether current price levels reflect fundamental demand or position dynamics cannot be determined from public data alone. The weekend timing of the central bank coordination call is particularly notable because precious metals markets continue trading through weekends via Asian spot markets and certain electronic platforms. If authorities were concerned about market functioning or settlement issues, conducting coordination while markets remain open suggests urgency. Historical precedent shows weekend central bank communication typically addresses acute stress requiring immediate attention rather than routine policy coordination. The September 2008 weekend calls addressed Lehman Brothers bankruptcy and AIG's liquidity crisis. The March 2020 weekend coordination established emergency dollar swap lines. In both cases, specific institutional stress or market dislocation prompted action. The absence of obvious comparable stress in current conditions makes the weekend call somewhat anomalous unless market functioning issues exist that are not yet publicly visible. The comparison to 1979-1980 illuminates certain dynamics, but also highlights fundamental differences that limit its predictive value. The historical parallel demonstrates that precious metals can spike when confidence in monetary stability erodes, regardless of nominal interest rate levels. It shows that real rates, properly measured, matter more than nominal rates for asset allocation decisions. It confirms that central bank coordination becomes necessary when market movements threaten systemic functioning. However, the current period operates within different debt dynamics, different currency regime structures, different supply-demand fundamentals in precious metals markets, and different policy constraint sets. These differences mean outcomes need not replicate historical precedent, even if some conditions appear similar. The question facing observers is not whether precious metals will continue rising or whether central banks will successfully manage current dynamics. Such questions cannot be answered without predicting human behavior and policy decisions that remain unknown. The relevant question is whether current market behavior indicates underlying systemic stress that conventional indicators do not yet fully capture. If precious metals are discounting future conditions rather than current conditions, what specific concerns might explain the discounting? If central banks are coordinating preemptively rather than reactively, what stress are they attempting to prevent rather than address? The system operates under constraints that did not exist in previous cycles. Debt levels limit tightening capacity. Balance sheet size limits normalization options. Geopolitical fragmentation limits coordination effectiveness. Currency regime uncertainty limits anchoring mechanisms. These constraints interact in ways that are difficult to model because they involve threshold effects where stable systems can shift rapidly when certain conditions align. Whether current precious metals prices and central bank behavior indicate approaching thresholds or simply represent normal volatility within a still stable system remains the central uncertainty. The weekend call suggests authorities are at minimum monitoring conditions closely enough to warrant irregular communication. Whether that monitoring reflects precaution or genuine concern cannot be determined from observable actions alone. The gap between what prices suggest and what policy communications indicate may be the most informative signal available, precisely because its resolution remains indeterminate.